you very much for coming to this session. It's a pleasure to be presenting my work, which is joined with Andreas Fuster, Andreas Hackethal, Philipp Schnorpfeil, and Michael Weber. All right, so in response to post-pandemic inflation, central banks around the world implemented large interest rate hikes. And of primary interest here, both from a research perspective, but most importantly from a financial stability perspective, is the impact on the budget of households with debt, especially mortgage debt, which plays a key role in the transmission of monetary policy changes onto household consumption. Here, we know that the design of mortgages in a country play a big role in determining the speed of the pass-through of monetary policy changes onto real variables like consumption. So unlike when mortgages have adjustable rates, if the interest rate on mortgages is fixed for a certain period of time, this pass-through is staggered, and mortgages adjust only once households need to roll over their debt. And bear in mind that if you have a 30 years US-style fixed-rate mortgage in mind as a benchmark, that's actually rather the exception in an international context. And in most countries, households will need to roll over their mortgage at least once or twice before it is fully paid off. Now, while the design, this fixed versus floating design of mortgages sort of mechanically determines when interest rate adjusts, actual transmission of monetary policy depends on awareness and actions that households take in response of at least partially predictable changes to their debt servicing cost. And we don't really know much about this anticipation. And this is where our paper comes in. So we study how German borrowers prepare for future anticipated rate changes on their mortgage by using a unique combination of data. We use bank records from a large German bank, together with experimental evidence and an online survey. So for the bank data, we partner with this large German bank and we get access to loan and account data of their mortgage clients. So sample selection happens in October 2024, and we get to observe all of their clients that had some mortgage debt outstanding with them between December 2017 and October 2024. And then we get to follow them until today. And that gives us roughly 240,000 customers. We also run an online survey to elicit subjective beliefs about mortgage rates, to elicit people's preparation ahead of interest rate reset and their plan. And also we give them an hypothetical vignette, and then we ask them some hypothetical scenarios to get to causal effects of certain shocks. We also, together with this bank, we're able to run a large randomized control experiment where we design and we send a letter to roughly 40,000 of their clients to inform them about the recent evolution in mortgage rates and also possible consequences for their mortgage payments. So let me first talk a little bit about how mortgages work in Germany. So the typical mortgage in Germany is a 25 to 35 years maturity loan with a fixed rate period shorter than the maturity of the loan, usually around 10 years. What is different from other countries is that in Germany, there is no prepayment option during the fixation of the rate. So borrowers cannot prepay, unless there are some exceptions, cannot prepay or refinance their mortgage before the end of the fixation is fixed. So this means that the interest rate on the loan is going to be that one from origination of the loan until the end of the fixation period. And at this point, borrowers have the choice of refinancing with their current lender, just originate a prolongation loan, to go to a different lender, so do an external refinancing, or to pay off the loan in full if they have the liquidity for it. This prolongation loan can already be agreed upon up to 6 months before the end of the fixed rate. You can already agree what's going to be the rate after the end of fixation with your lender. And actually, in Germany, there is a sort of unique feature where even though your interest rate is going to be valid until the end of the fixation, borrowers can take out what is called a forward mortgage to already lock in the rate up to 4 years ahead of fixation. So 6 years have passed. I'm 4 years before my fixation. I can already agree with the borrower, with the lender, and agree on what is going to be my interest rate once the fixed rate ends. All right, so I said before that our sample starts at the end of 2017 and goes until today, 2025. And this is the interest rate that we're observing over this period. The red line here plots the average interest rate on a loan expiring on in a given month in our bank data. And the blue line shows the average interest rate on a newly originated mortgage in the same month. So you can see that there is a big regime shift in 2022. Before 2022, people coming off their fixed rate period were facing interest rates that were roughly 2 percentage points lower than what they were paying before. And then after, instead, they're facing much higher rates, 1 to 1.5 percentage points higher.
How come you don't see the zero lower bound there on the orange?
On the orange?
Yeah, because that was, certainly at the beginning, was the period when the ECB rate was so low, if not negative.
Right, so this is a mixture of loans that are expiring. They could have had a 10-year fixation period, they could have had a 15-year fixation period, but you definitely see mortgage rate going very much down here. I mean, you see it here, right? So newly originated mortgages here have very, very low rates. The first thing that we document is a large increase in the uptake of these forward mortgages as interest rates start increasing. So here I'm plotting the number of forward loans originated by the month of origination, and the colors here represent how long ahead people are locking in rates. So the blue are newly originated forward loans that are locking in rates up to 1 year ahead. The orange is 1 to 2 years ahead, and then 2 to 3 and 3 to 4 years ahead. And so you can see, like here, these covered bond rates, interest rates start increasing, and people start exercising their option of anticipating refinancing. One thing that we see is that, so first of all, this increase is roughly proportional across anticipation. There is not like an increase in how far ahead people are exercising this option. And then pretty striking, we see that when interest rate reach this level here, this market basically dries up, as if people are not willing to lock in a rate that is so much higher. Now that was just the raw origination numbers. And so to have a better look here, I'm plotting the cumulative refinancing hazard by, so distance to expiration. Okay, this is in months, this is 12 months ahead. Split by the year of the fixation of the interest rate. So here the blue line, for instance, represents the cumulative probability of refinancing internally for loans with expiration in 2021. then the green line here is expiration 2023 and the yellow line is expiration 2024. And so this takes care of scaling by how many mortgages outstanding are eligible for refinancing. And we see that there is here an increase in the mass here and then here relative to previous years, indicating that so this is 24 months ahead for someone facing reset in 2024, which corresponds to 2022. So as people saw interest rate rising, there is this increase in refinancing here, and then this stabilizes downwards, and many people are still refinancing at the very last moment, up to 6 months ahead. Now, to actually more systematically look at the effect of interest rates on this probability of refinancing, we're estimating a hazard model. And we find the following. So first of all, sort of something that we already saw in the picture and is confirmed by these regressions is that the probability of refinancing is positively correlated with the difference between the rate on your old mortgage and current market rates. So the larger this difference, the higher the probability that people are refinancing. And it's also positively related with the change in the market rate. So when interest rates, current interest rates start increasing, people start exercising the option of refinancing more. So in magnitudes, 1 percentage point increase in the difference between own rate and market rates increases refinancing hazards by between 18 and 28%. So if there is, yeah.
You said 250 households, but we have 2 million observations. So is each household having multiple observations?
No, this is a panel.
So it's a hazard until they refinance.
Exactly.
So I would say maybe also add the household numbers.
Right. Okay, so this is all together. So the overall effect of borrowers' actions on their monthly payment. So if I want you to walk away with one figure in mind, be this one. So we want to quantify what is the role of households becoming active on the pass-through of interest rates onto their monthly payments. And we do this by calculating counterfactual. Had households passively rolled over their debt at the end of their fixation without modifying the terms of the loan. And we compare this passive counterfactual with the realized change in monthly payments upon fixation, upon refinancing. So the blue line shows these, what would have been the change in monthly payment had the household refinanced passively. And the red line is instead the realized change in monthly payments. And so we see that whatever actions these borrowers are taking are such that they mitigate the impact on their monthly payments. So here, after 2022, on average, we would have expected payments to go up on average by 82 euros per month, and they only go up by 20 euros. It's also interesting, it's not part of this paper as we really focus on what happens when interest rates increase, but we have a follow-up paper on the low interest rate environment. But also here, borrowers are taking action so to mitigate the decrease in monthly payment had they been completely passive. Now, but which actions are they taking in order to mitigate this? So either it's modification to the loan amount or differences in the interest rate compared to the counterfactual or modification to the maturity of the loan. And so we compute counterfactuals by only changing one at a time these different terms of the loan. And this is what we find. So here in blue is the full effect. So the difference between the new monthly payment and the counterfactual. So here they're going to pay more than the counterfactual would have predicted, and in the high interest rate environment, less than the counterfactual would have predicted. Now, what is the role of term amount and rate? So let's start with the amount. So extra payments that borrowers do during the life of the loan or at refinancing are such to reduce the monthly payments. But this effect is negative all over, both in the low interest rate period and the high interest rate period, and is only slightly increasing in the high interest rate period. Then there is the rate effect. So changes in rates have basically no impact on payments when interest rates are low, but explain a lot of this reduction or mitigation in payments increases in the high interest rate period. So this is what we saw before, that people are anticipating refinancing, and as such, they're able to fix a rate that would have been otherwise higher. But this, of course, is not going to be available to them forever, right? So in fact, you see that this effect is increasing over time. And then there are modifications to the term of the loan. So here, very importantly, this shows that borrowers are decreasing the maturity on their loan upon modification, thus increasing monthly payments. And this choice becomes much less popular when interest rates start increasing. And even some households extend the maturity of the loan slightly. Okay, let me jump to the survey. So we contact these clients of the bank through an online survey to better understand their subjective perception of preparation and interest rates. So we send an invitation, an email invitation to the survey to 41,000 mortgage customers in November 2024, and then we follow up with a reminder a few weeks after. Overall, we get almost 2,000 surveys completed. Of course, this is not a very high response rate, but in this literature, it's pretty common to see low response rates, and it's actually a little bit higher than other surveys run in collaboration with this bank. And we ask them about their beliefs about current and future mortgage rates and whether they have prepared or they will prepare for the reset. So we have two main findings here. Respondents to the survey in general have pretty accurate beliefs about current mortgage rates and past mortgage rates. So 83% of them believe or state that interest rates have increased in the past 3 years, which is correct. And they also have very good perception of the current interest rate, and half of them expect interest rates to remain high or rise further. And they're also pretty active when it comes to reporting whether they have prepared or they plan to prepare for their mortgage. And then we submit them this hypothetical scenario to isolate the causal effect on some of their actions of the distance to reset for their preparation and their beliefs, as well as the magnitude of the rate increase that they're facing. So we give them this role play scenario where they have to imagine that they have a mortgage with a residual balance of 100,000 euros, and that the interest rates on their fixed period is going to end in 1 year. They're currently paying 1.5%, but currently the interest rate is 3.5%, so they can expect that when they have to roll over their loan in 1 year, they're going to face a much higher interest rate. This is the baseline scenario, and then we vary randomly this vignette. We have a second variant where the distance to reset is longer, so they're facing the reset in 3 years instead of 1, and then variant 1 where there is a smaller increase in the interest rate. And then each respondent is randomized one of the three variants, and we ask them about different actions to prepare over the coming year. So first of all, we find that this is the baseline scenario. People report to be, 88% of them report to be actively searching for a best offer, 78% report to be that they would meet with their financial advisor, and 71% report that they would try to at least make partial prepayments to decrease the balance on the loan. And then around half of them also say that they would try to increase income, that they would take a forward loan, and that they would decrease spending. Now, how does this look in the other variants? So when the time to refinancing is longer, when they have more time, people are less likely to say that they will search or that they will talk with their advisor, and they're less likely to report that they would increase their income. When interest rate instead is, the expected increase in interest rate is lower, but the horizon is the same. Instead, we see that again, people are a little bit less likely to say that they will contact their advisor or prepay or increase income, but they're more likely to say that they will get a forward loan, which is consistent with what we have seen before, that people are more likely to get a forward when the difference in the loan is yeah.
So when you said in the letter the 3.5% or 3% is
Yeah.
the current for brand new or the current forward lock rate?
For brand new. That's the one that they could expect to lock in.
So you didn't want to inform them because they may not be able to lock at 3.5. That's the current. The forward lock may be 4.5 or 4.
Well, but it's gonna be in that direction.
So most households cannot calculate forward rates and say that I'm not, because they have to do this a year in the future,
Right.
they may not be able to get the brand new mortgage today.
Fine. That's true. Maybe they can get the brand new mortgage
No,
today.
I'm just curious. I'm not making an opinion.
Okay. So
Do you have an ability to make? I'm curious if most people are aware that the current market conditions for something that I will do a year in the future may not be the best statistics, and especially in bond markets, I can see what is the best forecast for my future loan. Because if I go to the bank will say no, 3.5. That's for brand new mortgage. But signing a contract with a forward lock, that's a different rate, and it may be 4 or 4.5 based on the market conditions.
right. Actually, they tend to offer the current rate
Really?
on. Yeah.
Okay, so that's.
I mean, there is a bit of a cost originating on forward mortgage, but this is how they explain it to us.
Okay, well.
I mean, my asset pricing colleagues are still very skeptical when I say that, but that's the explanation.
Okay.
Okay, so that was the survey, and as I said, we also run an experiment. So we send a letter to 48,000 of eligible borrowers. So there is a little bit of criteria that need to be satisfied. The borrower must have previously consented to receive some marketing emails by physical mail, and they need to have a relevant mortgage outstanding that is going to have more than 10,000 euros at reset to make the letter relevant, and also they don't have to have originated something new before 2022. Sorry, after 2022, because the bank does not want to bother their clients too much if they have already contacted them recently. And then we divide the sample into 4 groups, 1 control group and 3 treated groups, where we send slightly different letters. So this is the letter contact. Everybody is gonna receive these 2 sections. So everybody is gonna receive a figure that shows the recent evolution of mortgage rates over time. And everybody is going to receive a section where the bank tells them what are the options that they have available to try to deal with this possible increase in payments, which is either to do extra payments, lock in rates early, or increase savings. Then like 2 out of 3 letters also contain some information about uncertainty regarding rates. So we prominently say that currently the rate is this one, but there is some uncertainty about interest rates going forward. And one variant does not receive like some additional information on how an increase in the rate maps into increases in mortgage payments. I don't want to go too much into the differences in the letters because that in the end we don't find that they matter too much. So the first thing that we'll look at is a manipulation check. So we check the probability of reporting to having received the letter and to having read the letter conditional on receiving the letter. So 12% of the people in the control group, sorry, I'm not saying here, 12% of the people in the control group report having received a letter from the bank, and 7% of them report having read it, despite being in the control group. But we just ask about a letter about mortgages, because, I mean, it's not that implausible that they have received some other letter, because the bank at the same time may be sending some other marketing material. And then this probability of receiving and reading the letter increases substantially for people that actually received the letter. So the treatment seemed to have been noticed by people. However, we don't find any significant effects of our treatment on perception about past rate changes or the accuracy of current interest rates. People don't become more accurate because they received our letter, and also there is no impact on expected future rates or rate uncertainty. We do find that there is a little bit of a ladder effect on the reported propensity to reduce the amount of the loan upon refinancing if they receive the letter. So they're more likely to report to deleverage upon refinancing. And where we see a little bit of scope for the information contained in our letter in when we ask them about their knowledge about possible actions that they can take. So people that receive the letter are more likely to know about the possibility of making extra payments, and they're a little bit more likely to know that there exists such a thing as a forward mortgage. We then look at the propensity, I'll be quick because I'm running out of time, at the heterogeneity in the propensity to read the letter. And we find that people that have a large mortgage, people that have made some extra payments before, and people that have a high financial literacy and a lot of savings are also the same one that are more likely to say that they have read and received the letter if they have actually received the letter. So, which in a way limits the scope for letter effects, because it's already the people that have higher financial literacy that actually pay attention to this kind of information treatments. Finally, we also look at letter effects in the bank data, as we can follow people's realized actions after the treatment. So on average, we don't find any letter effects. People that received our treatment did not refinance internally more, did not anticipate refinancing, are not more likely to meet with their advisor, they're not more likely to make extra payments or something like that. Where we see some letter effects is only for people that are close to facing the expiration of their loan. On this subset of people that are close to seeing one of their mortgage coming off their fixed period, we see that they're more likely to refinance internally. They're more likely to refinance internally early, okay? Not to wait until the very last moment. They're more likely to meet an advisor. And they're also more likely, conditional on meeting an advisor, to get a mortgage out of it. There is no impact on extra payments or opening some savings products. All right. So conclusions. So we studied the timing and extent to which active actions by borrower affect the transmission of interest rates on monthly payments on their mortgage. We show that the borrowers in our sample do reduce the impact of interest rates on their mortgage, mostly by anticipating refinancing, taking this forward mortgage, and reducing loan balance, and also modifying the term on the loan. The survey shows high ex-ante awareness on the interest rate environment and also a high inclination to become active. And the letter intervention that we run has limited effects on beliefs and expectation, partially also because there is this self-selection into who reads and reports reading the letter. But we still find some effects on awareness of what people can do. And then in the bank data, we'll see some effect on the propensity to meet with an advisor and anticipate refinancing for people that are close to expiration. Okay, thanks a lot.
Can you go back to your conclusion, please? I just want to clarify your second point there. Do I understand that the bank, so the mortgagors can anticipate interest rate? But am I right?
Can
from
anticipate.
The banks do not see it, so why the banks anticipating higher interest rates? So why they're not offering higher? That's a bit odd, isn't it?
No. So I'm not saying that they have anticipatory behavior. So in the sense that they could wait until the end of the fixed rate
Right.
to take action, but they take action before that. So they're not passive. They wake up early and they initiate going to the bank and refinancing their mortgage. Because otherwise, if they were completely passive, they could just sit home, wait for the bank to reach out to them, offer them a prolongation rate, and then go with that default option.
So you started your motivation that this is an important information for market, macro policy, like the central bank. So now, could you then add a slide or something that says, because you look at the blue curve, I presume that's what the ECB or whoever is the macro economic policy regulator is expecting households to do. And they will expecting some effect of the raising of rates to achieve their goals, but they're not going to get as much of an impact because households adapt to that. Could you somehow quantify that, which will be important for the regulators to take into account?
Yeah, we could definitely try. Yeah.
So something like they're expecting 1-to-1 effect, but they're getting 1-to-0.3 effect or something like that because of the anticipatory and reaction of the household.
Yeah, for sure. Yeah, we could.
I had a question on this survey. I mean, you show the past kind of trend of interest rates.
Yeah.
But did you also think about including some sort of projections of future interest rates, let's say the next 1 to 4 years, to get like a sense whether borrowers do they act efficiently in the sense? I mean, if we are at 4 and rates are expected to go down, maybe it makes sense to just wait a few years to refinance something.
I don't remember if we did have this conversation. In any case, it was so by the way, this is not from the survey. This is in the letter. Okay, so in the survey, we just elicit their expectation about future rates. So this is in the letter. And in the letter, we then at some point just converge into having this plot. And no, we didn't include anything. But that could have been something.
I was just thinking maybe the people that share their expectation, they might be well informed or better informed, but if I know some friends or so, they don't really know what interest rates are going to be 3-4 years from now. So they could guide them in making their decision.
No, that could be another very interesting intervention that one could run, yeah. All right. Thanks a lot.